Welcome to the Investing Podcast presented by Tusk Media. This is Outsider Trading, an audio and video deep dive into the people, places, and things that we find most interesting in the market.
Hey everybody, welcome back to the Investing Podcast presented by Tusk Media. Andrew Hall here, Matt Krebsbach to my left, your right, and even further down the line, Benjamin Nye. We're here today to talk specifically about Amazon, do a little bit of an earnings preview, talk about some of the challenges with valuing Amazon. You'll notice that this video is a little bit different than most of them. We're not doing broad market commentary, we're just focusing on one company. We've done that a lot this week, lots of earnings previews, lots of earnings reactions, so all kinds of content coming at you, everything from Twitter to Amazon to Boeing, Polaris, you name it. We're kind of hitting all kinds of stocks. So make sure you hit subscribe wherever you are. If you're on Twitter, follow us at Tusk Media LLC. Same with Facebook, facebook.com/Tusk Media LLC. Seeking Alpha, you can follow us there, get all our stuff. And also iTunes. Search for us. That's the original home of the Investing Podcast. So you can check that out and get all our content. So we will jump in right now with Amazon. Interesting company. Huge headline type company. It seems like everybody's always looking at Amazon. There's a handful of companies that you really look at and hear a ton about. Apple, Amazon, Google. A lot of those are those kind of big names, so to speak, out there in the space. But Amazon's an interesting company as you start to look at earnings, I think. And you try to look at it and you try to make sense of it. It's really difficult. Kind of a great example of that is just some basic metrics if you want to actually look at Amazon. They traded a PE of 210. Versus an S&P 500 average of 22. So a little bit skewed there. Price to book of 31 times tangible book value versus the S&P average of 2.87. And even price to sales, which almost starts to get kind of into the real world realm a little bit, you're looking at 3.3 times that top line number versus, again, market average of 1.87. So Ben, I want to start down there with you. If you wanted to value Amazon, how would you start, and can you even make much headway there with any kind of traditional metric?
Yeah, so obviously price to earnings, you don't get very far doing that.
Yeah.
Free cash flow requires so many assumptions that it's difficult to really come up with something that you can feel really confident with
Right.
when you're forecasting discounted cash flows out 10 plus years for a company that's not really producing much in the way of actual operating earnings at the current time.
Sorry.
You can get Kleenex though. Like you can't order anything from Amazon, including Kleenex. So
I'm recovered.
So I would when I would look at it, I would look at so you can't look at price to earnings. Discounted cash flow analysis is kind of out the window. Price to tangible book, as you point out, is 31 times. That would be pretty bad if it fell to tangible book value.
Yeah.
And so what I kind of default to is almost the simplest metric around, which is enterprise value to sales. So the corporate entity as a whole, and then just see what it is relative to sales. And then you can make projections on, okay, well, maybe at some point they start to actually make a margin on those sales. Mm-hmm. So then you can kind of go from there, almost build out your own income statement. So I think it's useful to look at enterprise value to sales, and you can compare that across various businesses. So for example, Amazon is about 2.5 times enterprise value to sales ratio. Netflix is about 5 times enterprise value to sales. So undervalued.
Amazon is cheap. You heard it here first.
But then if you compare it to something like Walmart, more of the traditional bricks and mortar retail, they do have an online business, but it just hasn't taken off very much. Walmart is about 0.5 enterprise value to sales ratio. So there's obviously a huge disparity in that regard, and you have to make assumptions on that. So that's one way of looking at it. The second way I would look at it is isolate their cloud business, the Amazon Web Services, because that actually does make money, and they actually break this out in the quarterly financials. So you can isolate that, give that a really generous multiple, because it's in the cloud, so of course you have to give it a generous multiple. And then you can back out the sales for the rest of the business, and that takes the enterprise value of sales of the rest of the business down. And you can kind of start to, if you do some mental gymnastics, you can kind of start to rationalize the current price level. That said, what are the moats to Amazon Web Services? Everyone says they do it better than everyone else. But it's just a numbers game, in my opinion. I mean, why can't someone just set up their servers and sell it very cheap,
Right.
just like Amazon does?
Yeah, and I think that's really the story, is just kind of that, almost the scale and just
Yeah.
the size. And there's almost, as odd as it is for something that's really a back-end, non-surface level detail, it's almost like a prestige name to it, which is kind of odd. You don't really typically think of, branding for something like hosting services and, all that kind of stuff. Krebsbach, thoughts on, looking at Amazon, beginning to understand the value or justifying it. Do you have any?
I was going to piggyback on Ben with the EV to sales.
Mhm.
Let me ask you guys this: do you ever think they'll take out a significant amount of debt? Because they have very little right now, and that would probably change that EV to sales quite a bit.
I don't know what would drive them to take on a lot of debt.
Yeah.
It just seems like they've been able to progress so far
Right,
and have
yeah.
their hands in so many different buckets, so to speak, and do really well in so many different buckets. It's hard to really understand what would cause that to be necessary.
I think if you see a capital raise, I think it's more likely to come on the equity side.
I think so.
That earnings ratio that you announced at the beginning, that's just phenomenally cheap, and probably almost cheaper than the debt they could get. So from a capital efficiency perspective, you almost want to just sell equity because it's so much cheaper.
What if they spun off AWS, two separate companies? You heard it here first.
Ooh, we got theories coming. I don't know. I mean
But it
almost,
just is, sorry, but
Yeah.
it just seems like they're two completely different companies. Like I was saying, you really have to evaluate it two separate ways. And I don't know if like the capital allocation of like world domination is the best. That doesn't seem like it's a smart business.
but it almost seems like I don't disagree with that. I don't know that that's the most smart way to just take one bucket and throw everything else around it, but it almost seems like that's almost like the Amazon way. Like, let's have a cash cow so that we can supplement everything else that we're doing. That almost seems like kind of their MO. I don't know if you guys would agree or disagree.
Yeah,
For better or
yeah,
worse,
yeah,
I don't
something,
think that's
yeah.
necessarily, again, the most effective use of domination in one space, but
I remember we tried to evaluate, I think it was before Ben got here, I think it was in February when we had that big sell-off, and we had like a couple meetings about it, maybe, I thought it was a couple, maybe it was one, but we were trying to value Amazon and decide if we should initiate a position. This is after it dropped from like 600 to 400, I think. Let's roughly
Yeah.
say that. And I think you brought up price of sales, and I said I can't bring myself to buy a company like that, like just like philosophy-wise,
Right.
investing philosophy-wise.
we should have bought it then.
And I mean, we'd be double our money however.
Yeah, and that's, I think, the frustration or the challenge, especially to true like value investors, which is what we try to be. We may talk about more growthy names like this, or actually talk about Under Armour. Also in one of these segments, we touched on Twitter, a company that we don't own for clients anymore. But so, we do sometimes talk about some of these, I don't know, the sexier names out there just because it's a really sexy investing podcast. But I think sometimes it gets really frustrating from a value perspective to look at companies like Amazon and look at years like 2015 where it was such a driver of very narrow leadership and market performance, and to basically say, well, we kind of missed out there. We can't really make a case for it being truly undervalued. At best, we can maybe start to understand its valuation and start to grasp the realm of it. But then you look at it, and over the last 2 years, it's gone from $290 a share to now, $850 thereabouts right now, and people with price targets north of $1,000 a share, and that's over the last 24 months. I mean, it can be really frustrating.
Just like the analyst revisions that you get on Amazon are just insane. It seems like every other day you have an analyst saying, oh, $1,000, oh, $1,100.
Yeah,
I
It's
think,
continuous.
and if you read some of these reports, one of the things that's interesting to see how the discipline evolves over time for a lot of these sell-side analysts, because you'll see that discipline really start to waver. And to me, that's just not a good sign when what they're doing, they stick to their principles, and maybe they're wrong with those principles, but at least they're sticking with investment methodology and a process. When they start to modify that process, all of a sudden, in my opinion, it just seems that the amount of faith you can have in a lot of these expectations diminishes as they depart from that fundamental process.
And it's also one of those companies it's almost deceptive because obviously, a large number there attached next to that ticker, and you see something in the 800 to the 900. The thing moves really quickly. And so it really is almost like, hey, take the 2 zeros off and that's almost the volatility you're getting. It trades much more like an $8 stock than an $850 stock, which you would tend to associate with more stability or more, more range-bound trading. But I mean, the thing moves around a lot, which I think probably makes it equally confounding, not just for us, not just analysts who are looking at every single stock out there and looking for opportunity, but also for guys covering just Amazon. Probably makes it really frustrating. It probably lends itself, kind of to your point, to guys coming in, or girls, and changing their investment philosophy in terms of how they're actually valuing the company. Seems like the one thing we all agree on is the importance, at least in the read-through, of AWS, Amazon Web Services. Any expectations you guys have for what we're going to see for the quarter on that? Any thoughts or what to look for even?
I think Amazon Web Services just continues to be the powerful brand that you were talking about earlier. It seems like, when I talk to people in the tech space, they say, "Are you Amazon Web Services?" Like, that's their go-to name. So I would expect continued solid performance out of them. I'm not sure where street expectations are, because oftentimes, that'll govern how the stock reacts. I do think, though, in general, you'll see just a big stock reaction. It seems like that always happens in the post-market trading, and that'll be interesting to watch. There's going to be a lot of noise in the quarter. It seems like there always is. In terms of actually handicapping the quarter itself, I think that becomes extremely difficult to do because there are just so many moving parts for the business.
Krebsbach, any closing thoughts on
Yeah,
Amazon
I think
forward?
it really just comes on AWS for me.
Yeah.
Like the Amazon that you think of, like buying and selling stuff, or Prime, whatever, all that. I mean, if that breaks even, I think you're pretty happy with that. It makes a little money, but I think it really strictly comes down to AWS.
Yeah, I think that's the story there as well. So we'll keep an eye on that. We'll maybe do an update on it later in the week or next week or something like that. But this is the Investing Podcast. Hit subscribe. Thanks for being here. We'll talk to y'all soon.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are our professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.